Let's get more with Monica Fan, a currency strategist at State Street Global Advisors. Thanks very much for speaking to us. First of all, let me ask you about some of Bernanke's comments at this testimony. He said that the federal funds rate is likely to remain low for an extended period and that the central bank would start tightening policy at some point. So he was very vague on that. When do you think he may be raising rates?
I think the reference to an exceptionally low interest rates for a prolonged period of time certainly does rule out any imminent interest rate hikes, particularly over the next 6 months.
Now, unemployment remains very high. Growth is somewhat sluggish. Banks are not lending. Policy rates are already near zero. What more can the Fed do at this point?
I think certainly it's a case of wait and see. There were some positives about the economy, despite, as you already mentioned, there's a lot of concern that the unemployment rate may have peaked. However, the job market remains very sluggish, yet consumer spending and also business investment is looking up.
So do you think that these sorts of conditions will continue over the next 6 months, that they will materialize?
I certainly think that is the base case. I mean, the risks of a double dip, let alone a triple dip recession, do look remote. And obviously, the US dollar overnight has actually strengthened on the back of what is quite positive environment for asset markets with low interest rates for the foreseeable future. That is, of course, despite the US dollar having bounced on interest rate expectations actually moving up after the discount rate had increased.
It's interesting because the Fed has taken a very cautious approach to this situation in the past. There are those who say that the fact that interest rates were kept so low after the 2001 recession sowed the seeds of the current crisis. Is there a danger that the Fed could keep rates too low for too long?
Well, I think the fact that the Fed has already started to pare back many of the emergency measures undertaken through quantitative easing is a positive sign, and they're very aware, for example, at the moment that inflation expectations are still very low and stable.
Now, I want to ask you about another development that we've had, speculation that Greece's credit rating will be downgraded. What would this mean for Greece? How much more difficult would it be for the government to turn things around?
Well, I think that already the government's in a very difficult situation. There have been a lot of protests against fiscal austerity packages, and certainly Moody's threat of further rating downgrades is obviously a negative for the euro, especially with the markets very unconvinced at this stage that there will be a credible fiscal austerity package.
Monica Fan, thanks so much. Appreciate your thoughts on this.